Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to our latest episode in the InvesTips from the CIO's Desk series. Today we're talking about commodities, the raw materials that help power the world and that can also play a role in your portfolio. Now, commodities might sound technical, but the idea is actually very simple. These are basic physical goods like gold, oil, wheat, coffee, and natural gas. They are part of everyday life. If you drive a car, drink coffee, or buy groceries, you already have some understanding of commodities in action. So why should an investor care? Well, there are three main reasons. First is diversification. Commodities do not always move in the same way as shares and bonds. And this means that they can help balance a portfolio, especially when traditional markets are under pressure. In simple terms, they may help you avoid having all your investments rise and fall together. Second is inflation protection. Some commodities, especially precious metals like gold, often hold their value better when inflation is high. So when the cost of living rises, commodities can help protect purchasing power. And third is access to global trends. Commodity prices are influenced by real-world factors such as supply, demand, weather, and energy needs. This means they can give investors exposure to major global themes in a different way from stocks. Now, at a headline level, there are two main traditional types of commodities. So first is hard commodities, which include things that are mined or extracted, such as gold, copper, oil, and gas. And soft commodities are either grown or raised, such as wheat, sugar, coffee, and livestock. And there is a newer category as well, environmental commodities, such as carbon offsets and renewable energy certificates. Now, if you're new to investing, the good news is that you do not have to buy barrels of oil or store gold bars at home. For beginners, common options include mutual funds, index funds, and commodity ETFs. These can provide exposure to commodities in a simpler and more accessible way. More advanced tools like futures and options do exist as well, but they're usually better suited to experienced investors because they can be more complex and also more volatile. Of course, as with any investment, commodities are not risk-free. Prices can swing sharply. Costs, regulation, and global events can all affect returns. And that's why it's important to start small, use regulated platforms, and focus on assets you understand. Gold is often an easier starting point than oil or agricultural markets, for instance. This is not just because the drivers are easier to understand, but it is less volatile than many other commodities, and its diversification benefits relative to other traditional asset classes, such as stocks and bonds, are well understood. So the key message is this: commodities are not just things the world uses every day. They can also be useful investment tools. Used judiciously and with the appropriate sizing of investments, they may help diversify a portfolio, provide some inflation protection, and add exposure to global economic trends. Thank you for listening to me today. That's all we have time for. I look forward to catching up with you again soon. Please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.